All right, what's up, people? Good morning and happy Friday. We'll jump it in here. Quick look at the futures. Ain't pretty. S&P 500 down another 0.5% here. The Qsters are down about 1%. The small caps, which I got a short over here right now, they're down about 1/3%, and then your good old Dow. Dow Jones down a little bit here as well. So I think the big story this morning, well, there's actually a few of them, but one of them, we had Netflix earnings last night, and wow, we can't even go down far enough. We need a weekly chart. We're going to open up at like 410 this morning. So a little gap down. A little gap down here this morning for Netflix. I think that's what, maybe 20% on a percentage basis. So Netflix is going to open up around 410. I mean, it blows through every weekly moving average. So at this point this morning, right, your weekly chart slammed. Loses everything. It loses trend, it loses structure, and should go without saying it loses momentum. We might have to take it to a monthly chart here. So this is interesting because, it's not so much a Netflix thing. We're just seeing a lot of this in the market right now. So very much like your S&P 500 and your QQQ, old Netflix here. Where's my tool? If you look at Netflix, market bottoms after COVID, the vid, and you fire a monthly squeeze. So big old monthly squeeze here, fires to the upside. So the momentum and the crazy ass push makes a lot of sense. What also makes a lot of sense here is just like a 30-minute chart, a 5-minute chart, or a daily chart. You build up energy. Actually, look back here. You build up energy in a squeeze. You fire the squeeze. And then once your squeeze basically dies out, right, you lose momentum. You tend to pull back to the 21 EMA. You see this in daily charts. You see it all over the place. This just looks ugly, and it is ugly because it's a monthly chart. But the same principles apply. We build up energy in a squeeze. We fire the squeeze. Once you start to get those dark blue bars here on the histogram, all that's trying to communicate is the squeeze is getting tired. And when you lose that momentum, you typically come back to the monthly, or you typically come back to the 21 EMA, regardless of the time frame. So big push, reversion to the mean, big push, reversion to the mean. So because of the size of the push, on a monthly chart, the pullback is pretty nasty. I show you this because when I look at the really any of the indexes, but we'll take the QQQ for example. I'm actually looking for the same pullback, just based on the same principles and really based on the ebbs and flows of the market. So very much like Netflix, we got Corona, everything bottoms out. We're in a big monthly squeeze. Squeeze fires to the upside, but it's getting tired here. So you're losing all that momentum that brought you to this point. And then as you lose momentum, you're kind of opening the door for a potential flush to the 21 EMA. So your monthly 21 for the NQ here, and we'll do the QQQ. I think a lot more of you probably look at the ETF. Squeeze fires, squeeze gets tired. And if you start to lose your 8 EMA, you're usually going to come on down towards your 21. So for the Qs here, now mind you, the market could bounce like a bat out of hell next week. It could start to fix a lot of problems. It could shift structure. In the event the market comes back in here and fixes structure, I'll get right back on the bullish side of things. So no bias on my end. I'm just going to follow the charts and the structure. But your monthly 21 is down here around 320, 325. So on a daily chart, it's like, oh my God, that looks like the end of the world. Right? Looks like your market is just totally collapsing. I think you want to spend a few minutes there on that monthly chart. The reason we had so much crazy ass momentum for the last year and a half is because of your monthly squeeze. Right? Is it the Fed? Is it the quote unquote money printer? Let's just call it a monthly squeeze. Right? We all kind of speak this language. So you build energy, you release the energy, you lose your energy, typically coming back to the 21 EMA. So this monthly squeeze, it was the cause, in my opinion, of that crazy rally, right? All that crazy upside. It was the cause of, buy every dip. If the monthly squeeze is responsible for the crazy push, the monthly squeeze losing energy should be responsible for your first good legit pullback that we've had in, I don't know how long. So that's kind of the level I'm working with to the downside. That's a bit more bigger picture thinking, right? What this means to me in the short term is I'm not really trying to buy the dips. What I'm trying to do instead is wait for the market to flush, wait for the bounce back to the upside, and then I'm trying to short the bounce. So when your monthly chart has momentum and your weekly chart has structure, typically you're looking to buy the dip. But as your monthly chart loses momentum in your weekly chart, totally loses structure, not really trying to buy the dip anymore. It's a totally different set of circumstances. We're not buying the dip into key support. We're not buying the dip with the ultimate gas tank pushing us forward, the monthly squeeze. So I'm trying to sell the rips. I'm trying to short the bounces. And my target in a bigger picture, sense would be the monthly 21 EMA. And in the event we actually get to the monthly 21 EMA, I think you back up the dump truck and you basically buy the crap out of everything. But we'll cross that path when we get there. But again, in the short term, these are the different things I'm looking at saying, okay, the path of least resistance might be to the downside, but you still want to pick your spots wisely. So even in a bullish market, we don't really want to take long positions at 2 to 3 ATR, right? At that point, we're usually a little bit late. And at that point, you're better served wait for the dip, then get long. Well, in this kind of market, this just really isn't the best spot to short. It's kind of like getting long up here. You missed the easy move. Now, the market could continue to roll over, right? So what the market does and what you do, two totally different things. But the game plan I'm trying to work is if we can get a bounce here, into the falling 8 EMA, I'm looking to short the bounce. And my two primary targets here would be the QQQ and the small caps here. We got a short on the small caps right now. So that's what I'm thinking as far as a game plan that makes the most sense. And just keep in mind, 2020, most of 2021, we all had a lot of success because we were just simply on the right side of the market. So my thinking right now is it's going to be a nasty year for anybody still trying to get long. Right? And hey, if the market shifts structure here and it's time to get long again, then we get long again. But the point being is, if you had any success in 2020, any success in most of 2021, you were on the right side of the market. So make sure you continue to do the same. And then as I'm running my scans here, there's just not much left to the upside. There's a few of them, but here's the issue, right? Even in a market like this one, from time to time, you're still going to run your scans. You're going to have great looking setups. The issue right now is they don't have the wind at their back. So you look at Qualcomm, who's kind of breaking down pretty bad here. It's a picture perfect daily squeeze of buy signals for like a month and a half, 2 months. But think about your market since November up to this point. You lost momentum, you lost trend. So these good looking setups, they don't really have the wind at their back anymore. Even worse, even the best of the best, they're liable to break down. So we've also seen a lot of this over the last week or so. In my opinion, Qualcomm was one of the best looking setups in the market, and she's looking a little rough here. Another one was AutoZone. Buy signals, buy signals, buy signals, and down it goes. There was FN, and we took a loss in MP yesterday. And this is like a beautiful setup, but there's no wind at its back. Right? You're trying to go counter trend against the overall market. Really difficult. So there's a few left. There's Pepsi. For what it's worth, it's a great looking setup. So in any other market, I'm probably buying Pepsi this morning. I'm just going to follow the buy signals blindly and take my position. I don't know about right now, but Pepsi is pretty solid. There is ABBV. There is Alcoa. There's a few of them out there. There's a Southern Company. The point I'm trying to make is these kinds of setups, they work like super, super good when the market is bullish. it all becomes a little bit more difficult now. So one thing I got to do this afternoon is tweak my scans up a little bit, looking for more things to short. But I think you can keep it easy. Focus on shorting the indexes. So you take your pick. It could be the S&P, it could be the Qs. What I'm really liking about the small caps here, and granted, it kind of made the flush into our target, into the close yesterday. Weekly squeeze looks really sketchy. So there's no stacked DMAs. If y'all look over here to the left, there's the 10x bars. So that's your momentum reading on every time frame. Weekly chart down to a 5-minute bearish momentum. Now the QQQ, the weekly squeeze is catching up. It's not as ugly though. Histogram is still positive. You still have stacked DMAs. So I do think this could fire short. The IWM kind of looks like the one that's going to do it first. But I wouldn't short here. You might make money. You might get short and have to sit through a pretty nasty bounce. So I would wait for the nasty bounce. But here's the key in this market. Long, short, debit spread, credit spread. I want y'all taking every single trade thinking about risk reward. Right? And make it super, super specific. So we talked about this in my webinar last night. Before you pull the trigger, again, on a long, a short, on anything, there's two things you want to identify. The first thing is your targets. So with IWM here, we're going short. We're pricing up this trade on January 10th. So before we pull the trigger, identify the target to the downside, which for us is just about $200. Then identify your exit to the upside, which for us was about 222. Reason being here, that was your weekly 21 EMA. If I'm thinking a weekly squeeze is going to fire short, I don't want to see it back above the 21. Now, of course, my exit is trailing, right? So my risk gets a little bit better as the week goes by. But those are our two targets. We're going to try to cash out at $200 or lower, and we're pretty much wrong here, and we're going to cut the trade at 222. So identify those two targets before you take your trade. And then my suggestion is, really get used to playing around in the Analyze tab. Get a sense of the trade. Does a trade you're looking to structure, credit spread, debit spread, whatever it may be, does the trade actually make sense? Okay. Your targets might make sense. You might pick a good exit level. You might pick a good profit taken level. But if you don't structure the right options trade, the risk reward might be terrible between the two prices. So on the Analyze tab here, just to give you a sense of what I'm talking about, we sold a March 18th expiration, 208, 212 call credit spread. So we're selling the in-the-money calls. But more importantly, our line in the sand to the upside is 222. So what's today's date? The 21st? So if today, for example, we're cranking through that 222, I'm probably going to take the trade off here. And on a 10 contract basis, I'm down about $450, $460. Right? So that's my risk. If we move into my exit level, I'm risking about $45, $46 per contract. So now ideally, you take that number, and then the profit at your target should be bigger than that loss. It should be bigger than $450, $500 per contract. So down around 200, you can see we're up about $1,000. So per contract, your risk to the upside is about $45. Your profit potential to the downside is about $100. So you're risking a little bit better than 1 to 2. That I think is going to be super important in this market because, quite frankly, for like a year and a half, it really was as simple as let's just find a good setup, let's get long, and we don't even really got to think about risk. And maybe we get long and the market pulls back for 2 to 3 weeks, but it just keeps coming back to save you. So you get long, you're taking some major heat, and once again, the market bails you out. And you're taking heat and you just keep on getting bailed out. I don't think you want to work that kind of mindset anymore. Long position, short position, what are my targets, and what's the risk reward between both of those targets? Now with the IWM trade, say my risk appears $50 per contract, and my profit down here is only $25 per contract. That trade doesn't make any sense. If I'm wrong, I'm going to lose 2 times more than what I can make if I'm right. what do I need? Like a 95, 99% win rate? The numbers don't make any sense. So as I'm pricing out a few potential trades here, that's what I'm focusing on. Now, the difficulty trying to get short after such a big flush, it gets a bit more difficult to work the risk reward, unless you want to put a really tight stop around it. But that's what I got for y'all this morning. If you got any good charts you want to take a look at, we can do that here. Again, you got like 3 men standing. There's Pepsi, there's Alcoa, there's XLP, which is pretty decent here. Energy's still strong. That's a little extended. But if we go sector to sector right now, there's just not good structure anywhere outside of energy and XLP. So if you look at XLK, nasty. Look at XLC communications. Ain't pretty, that's for sure. IYT, the transports, nasty stuff there. IYR, real estate, ugly. The utilities. They're not terrible, but they ain't great. There's healthcare, nasty stuff. There is the industrials, nasty stuff, and then the financials. So also keep in mind, we're in like the heart of earnings season right now. And earnings season has been too kind to the financials here. So XLF, that starts to break down. If you look at Goldman Sachs, big gap down after earnings. JP Morgan, big gap down after earnings. And now Netflix, as of last night, kicks off the party here for your big tech, big FANG stocks. And we're trading so low that we can't even see it here on the chart. So that's when you know things are ugly. 410 is somewhere down here underneath my computer. So the fact you got to take it to a weekly chart just to see where you're going to open, that's some nasty stuff. But the perspective I want to give you before I answer questions here, does Netflix look like just total destruction, total death on the daily chart? You better believe it. Does Netflix look just totally hammered here on the weekly chart? Absolutely. On the monthly chart, yeah, you know what? The monthly chart still is going to look pretty shitty this morning. So, there's no nice way to paint Netflix here. Yeah, nasty stuff. So next week, I think you have Apple. I got a few notes here. Let me see. Apple's next Thursday. And look at Apple here. Daily chart starting to break down. If you look at your weekly chart, bare minimum, I think Apple's coming back to 160. That's just normal ebbs and flows. We build the squeeze, we fire the squeeze, we come back to the 21. We build the squeeze, we fire the squeeze, we come back to the 21. So I think, earnings aside, Apple's shaping up for another $5 pullback. Depending how earnings go, we'll have to see if it gets any uglier. Then I think you have, let me see, Microsoft is next Tuesday. In this one as well. So the point I'm trying to make is our market for the last year and a half, in a nutshell, has been that massive monthly squeeze firing to the upside. In your QQQ and your S&P, if they break down and they make what's quite frankly that healthy pullback, the 21 EMA, just understand in the short term, everything's going down. From a monthly charts perspective, I think it's actually going to be a great buying opportunity. It's your first legit, real healthy pullback in years. But in the short term, just understand buying the dip, buying calls. If you're trying to work that kind of game plan as your market is making that big of a pullback, it's going to be a little bit rough. And I don't think we're going to go in a straight shot down to the monthly 21. So in terms of, where could be the opportunity here, looking to short the bounces. Looking for gradually the market to potentially grind down towards that level. But as I mentioned earlier, if next week everything changes, everything's looking good, I'll get long again. Y'all know I'll get long again. But that's what I got, guys. Be patient. Don't shorten the hole. And just understand a lot of the dynamics at play right now. that are causing the market to shift. Then, of course, understand that earnings could add a little bit of fuel to the fire. So here's to hoping that Google, Amazon, and Apple don't gap down 20% after earnings. If they do, look out below. Look out below. Trader Kanoko, I think Amazon's a little bit late as far as earnings. I think they have. No, we're getting there. Oh, it's almost February. Yeah, where am I right now mentally? Oh, it's 21st. I'm thinking we're like early January right now. Yeah, Amazon is on the 3rd. Amazon's actually at the monthly 21. Interesting. But yep, we are in the heart of earnings season. Yeah, David, end of the quarter. Yeah, AM, you know what? And believe me, I've been the guy for the last 2 years here to pound the table on the upside. Not right now. Such a big part of the reason that Apple had a big year is because of that QQQ monthly squeeze. So this is just a great reminder: as the indexes lose structure, you're playing the game of trying to pick the honey badgers, right? And of all the thousands of stocks out there, this kind of becomes like a needle in the haystack. Right? You're trying to find the handful that might continue to trade higher, going against the grain. So in terms of what problems do I see for Apple here, all the problems start right here in the indexes. So I'm with you there. I think, bare minimum, and again, it's actually just a healthy dip, would be the dip to the weekly 21. And that's nothing. That's just normal trend. Fire a squeeze, pull back to the 21, fire a squeeze. Not to get too far ahead of ourselves, but based on the structure of the indexes, based on just other things we're seeing here, it could be a lot more than just a cute little dip to the weekly 21. And let me also stress here, I'm not going to be in a rush to buy that dip like I was basically the last 2 years, because you're buying the dip in a different environment. If Apple can dip to the weekly 21, and there's your QQQ and your S&P, and they look super bullish, right? They got great structure, momentum. Then I think you buy the Apple dip, hand over fist. But just look at the cues here. Right? So I'm talking with a few traders the other day, a few buddies of mine, and they're still pretty adamant on the long side. Right? Buy the dip. Why are you trying to short the market? And their argument was, well, what's different about this time? We've seen the market pull back. We've seen these, 2 to 3 to 4 week periods where there's some nasty selling pressure. The difference is, yeah, that was a nasty little dip. Sure. That got pretty nasty. That got pretty nasty. So I agree with them there. Yeah, you've seen some ugly daily charts for sure. Here's a difference. Each of those ugly 2 to 3 week periods, it's a textbook picture perfect, like super clean pullback to the weekly 21. In other words, it's nothing more than a buyable dip on your bigger time frame. You don't lose structure, you don't lose support, you don't lose momentum. Right? You never lose momentum. We have stacked EMAs. As a swing trader, that's what you dream of. We're in a crazy uptrend and we're pulling back to the weekly 21. A little bit different this time. Now the weakness in your daily chart has impacted your weekly. You're under your weekly 8. You're under your weekly 21. And this might be the first close under -1 on a weekly chart since the vid, since the Rona. Right? So things are changing. Just major things to keep in mind here. And then, right, what's different about this? Well, every time we're pulling back here over the last year or so, one, we're pulling back into weekly support. So it's just like picture perfect. But you're pulling back into weekly support is your monthly squeeze just keeps pumping that ridiculous momentum. Right? That's why buy the dip was so easy. You got the biggest gas tank in the world pushing you forward. And every time it looks like things are getting a little bit sketchy, it's the best buy the dip you're going to get. So both of those things have changed. That's why it's different, at least in my opinion. You're not buying the dip here into a textbook, beautiful looking weekly chart. And you're not buying the dip here with momentum and wind at your back. So these are the things I'm seeing that are a little bit different about this environment. And the thing for us as traders, myself included, we're very slow to adjust. We talked about this last night. It's not like the market changes, in 5 days. In my trading, and I think in a lot of, y'all's trading, November, December, things definitely got more difficult. Of course they did. Easy to say in hindsight, but of course things got more difficult. We lost our momentum, right? So all the shit that's working over here, slowly, it all becomes a little bit more difficult. And now I think a lot of us are getting to the point where we're saying, okay, what's happening here? What worked like magic, so to say, for the last year and a half, it's all becoming a bit more difficult, right? And there's more losing trades. There's a lot more break even. There's just a lot of back and forth. Now I think we're starting to see, okay, things are shifting just a little bit. So for today's session, I would like to see a bounce. I don't think I'm going to get my bounce, but I would like to see a bounce here to try to short it. Not looking too promising right now. Gabe, I think John and I are actually the opposite. I think I'm always going to have a little bit of closet bull in me. However, it's like a breath of fresh air, to be honest. I'm not bullish right now. My name is Taylor Horton, and I'm not bullish. I've been so focused on, for good reason too, just that one side of the market for the last handful of years. And I've definitely taken some losing trades, continuing to try to get long here. It feels good. It feels good to say, okay, you know what? Screw what was working last year. What's the market doing right now? What's the path of least resistance right now? And I do know JSC was trying to short the market earlier this year, myself included. And not to speak for the big goat, it didn't work. It really didn't freaking work. Reason being, every time your daily chart looks shortable, here's your buyable dip to the 21. So a lot of us were doing this, right? Here we go. Bull market's over. We're calling tops. But your monthly squeeze is still firing long. You're still just pulling back to your weekly 21. Now I think getting short makes a lot more sense. Trend, structure, and momentum or lack of momentum, now it's working in our favor. Yeah, Harley, good question here on the average true range. Generally speaking, yes. And to be a bit more specific, I'm looking for about 2 ATR in this market. With all the momentum of a monthly squeeze, Tesla's probably an extreme. It's an extreme for sure. But there was definitely a lot of this last year. Just crazy, outsized, above average moves. I'm looking for the easier moves this year. So with IWM, for example, the weekly chart has kind of made the move I'm looking for. Maybe we get a bounce, we add a bit more, but I think you want to keep things just a little bit shorter as far as your target to the upside. So instead of trying to, or the downside, right? But Harley, instead of trying to, just consider more frequency. Okay? So maybe on each individual trade, you're not working as big of a target. So call it a base hit, call it a double, but we're trying to rinse and repeat way more often. Where a lot of last year, at least in my trading, was, all right, I'm going to find a squeeze. I'm going to be transparent, probably a bit too much risk, and I'm going to strap onto that bastard and hold on tight. Okay? and you push and you push and you push and you just keep on pushing. Now, imagine Google's bullish right now. I'm looking to take my entry, give me the easier, shorter term pop. Then I'm going to take profits and I'm going to go look to do it somewhere else. Versus I'm going to walk around being long Google or even short something for 30, 60, 90 days. So I think it's a great question. I think it's a good target in this market. Is about 2 average true range moves to the upside or the downside. Awesome question, Jason. Awesome question. Yes. Right. And it's not so much I would call it, I wouldn't call the histogram flipping to yellow, bullish. Not that you are, but yeah, that's where you start to get a potential bottom. So if we just think in terms of momentum, and Google's a decent example here. What gave Google a nice little pop? You got some fresh bullish momentum. As you lose that momentum, Google kind of comes in. And then as you develop bearish momentum, Google gets spanked. Once you start to get some exhaustion, there's your first heads up. All right, it might be putting in a bottom. But Jason, here's what I think is interesting. So say you've got, we can use Google. Say Google's your major focus right now. By the time that happens to the daily chart, usually, not always, but typically by the time Google is printing yellow histogram bars, it's typically made a pretty good bounce. So if this is something I'm interested in getting long, looking for the oversold bounce, you can start from the ground up. Because the first thing that's going to fully shift is going to be your 30-minute chart. Start getting some yellow bars here, some light blue. Then that shift of momentum hits on to the hourly chart. Then the 2-hour, then the 4-hour. So the way I look at it is if the 30-minute chart can't even show me signs of exhaustion, I'm probably a little bit early here in terms of looking for that bounce. It's a great question, though. I think, working from the ground up with that kind of mindset can be really helpful. If, Jason, you're looking to catch that nice bounce to the upside. Sometimes it'll hang out and the histogram turns yellow and gives you plenty of time. Not always, though. Not always. Hey, Mr. Rocky, good call out here. God, how could I forget Tesla? I must be getting bearish. Yep, we got Tesla next week as well. Now, let me give kudos where kudos are due. Tesla holds up pretty good here. I'm not going to get long. Tesla doesn't hold up bad. Now, it could fall victim to the market, but you got to give it credit. It's still trading within its average true range, from the 21 EMA. There's not too many names out there we can say the same thing about. Not Apple, not Facebook, not Dazan. Oh, NVIDIA. Look at NVIDIA. So it's always difficult to see your heroes fall from grace, and we're seeing a lot of that. Tesla says, I'm going to keep on fighting the good fight here. You got a couple of squeezes too. Again, not something I do with anything with right now. You got a nice 3-day squeeze setting up. So Tesla, we collectively give you props here. We give you props. Marcus, you're looking for a short here. I like that. On NEO? Well, the first thing I notice here is the EMAs. They're stacked negatively. So in my rule book, I can only go short. Can't get long if we got negatively stacked EMAs. Marcus, here's what else I like, though. You're not waiting until the thing's down 10% to short it. So this trade might not work like any other trade. I like your trade, though. Assuming this is something you took. And even if we can open up in the same neighborhood this morning, yeah, I think we're going to open up about flat here. Momentum supports a short. 3-day, daily, almost every time frame you got bearish momentum. You're under the 21, but you're right there at the short spot. Histogram is starting to shift, and you have negatively stacked EMAs. In your weekly chart, that doesn't have any structure either. Negative histogram, it's under its own moving averages, there's no stacked DMAs. I like the structure here for a short for sure. But more importantly, this is where you want to get short, not down here at 25. That's where you want to cash out. So I think you're onto something there. You're in that, Marcus? All right. Beautiful, beautiful. Hey, good morning, Steve. Yeah, Susan, we can take a look. Susan, what's the ticker for that? Yeah, Eric, we'll take a look at Piton as well. And then fares, yeah, gold is a beauty right now. Susan, let us know the ticker there for Senseonics. It's not SE, is it? Oh, that's C Limited. All right, while we wait for Susan to do that, Eric, in terms of Piton, oh, there we go, SCNS. All right, hold that thought. Reminds me of NEO. EMAs are stacked negatively. You're in a high compression squeeze, which these can always be interesting. Right? But just take the three, kind of the big three: trend, structure, and momentum. Now, I tend to gauge trend from a bigger picture perspective on the weekly chart. So one of my rules is if I'm going to get long a stock, it has to be trading above the weekly 21. You're above your weekly 21, generally speaking, path of least resistance is to the upside. So we don't really have that trend going right now. Structurally, there's no stacked DMAs. And then how about momentum? It all continues to roll over a bit. So that's the kind of, excuse me, this is the kind of thing I would look for a potential short. Kind of looks like NEO. Actually, very similar to NEO there. Sisters. That's what I'm seeing there for SEN. Trend, structure, momentum all point towards path of least resistance might be to the downside. Now, Eric, in terms of Peloton, this is just nasty, nasty stuff here. Now, as a preface, right? I don't look at the fundamentals. I don't look at the earnings. So it's not like I have a great grasp of what's going on here in the company. With that being said, is there room for more downside? I think absolutely. Again, this is just my opinion, so you take that with a grain of pepper. But we saw a lot of this last year, right? But because of the pandemic and, because we're all trapped at home, COVID stocks, right? The stay at home stocks, it just got a little bit nutty here. So Piton's going from $17 to $170. So, I mean, that's great if you're long and it's great if you're trading that. But from like a financial perspective, the growth in the price of the stock doesn't really make any sense. So in other words, what kind of happens a lot of times with these types of names is you come back to reality. Just in my opinion, it's kind of what's happening here. Investors, they're coming back to reality. And now I believe the company has issues on its own right, in terms of delivery, in terms of production. So, you mix those two things together. Stock price grew way faster than it really ever should have. So fundamentally, that didn't make any sense. So now reality is kind of coming back into play here, and then kind of sprinkle in, well, from what I can gather, the company's having some problems. And I think for us as traders, a lot of times it's like, all right, this has got to be the bottom, right? This thing's gone from 170 to 100. It's down 70%. Yeah, there's no way this can go down even more. And then when it drops another 50% from 100 to $50, a lot of us are thinking this just can't get any uglier. Then they cut it in half again, from 50 to $25. So I'm not saying it goes to $12 per share. The point being is it can keep on getting nastier. So again, I don't really have like too much context as to what's actually going on with the earnings and the delivery numbers. The thing I kind of see here is it grew way too fast. The best thing for Peloton would have been, 2020 was a year of nice moderate growth. Maybe the stock's up 50% for the year. Because now what happens is you get these crazy ass expectations. Now the company might continue to actually do well, but the numbers over here, they're really tough to duplicate when we're not staying at home, right? And when the world in some fashion kind of goes back to normal. So they might continue to grow month over month, not at that pace though. And that's one of the bigger issues here. Wow, GoPro. GoPro vibes. Now, Wilkin, you bring up a good point. I wouldn't short it here either. I definitely wouldn't short it here either, because that's just not a part of my game plan. We're down at -4, -5 ATR. Is the company in trouble? Maybe. Was this, did it get too hyped too quick? For sure. Still not a good short entry, in my book at least. So I'm definitely with you there. Willie G. All right, guys, I got to be in the options room here in a few minutes, so we'll go through a few more. Let's see, SOFI. So this is kind of what I'm referring to, the shorter moves in this market. It happened quick. Granted, it happened quick. I'd be looking for an entry near the 21 EMA. Looking for a nice little pop into about +2. Keeping them short and sweet there. Keeping them short and sweet. Spacewalker. I like that name. Uncle Warren, Berkshire. Spacewalker, you're looking for... No, it's not. Okay, Baker, BKR. Well, I've never heard of it, but it's a sight for sore eyes. Nice move. It made the move I would have been looking for, from the 21 into about +2. So nice setup though. For me, the move is kind of done and over with, but this looks good here in the market of some not so good looking stuff. Nacho's got some CRC. I'm gonna steal that from you real quick and put that on the watch list. Never heard of it. Doesn't matter. Good structure. Early buy signals, weekly and daily stack DMAs. This is very, very solid. Very solid. And there's a weekly squeeze. Good find. Good find here. Wonder how the options are, but very nice. Very nice. And then David, I think Pepsi's... So with Pepsi, David, it's not going to be... The issue here won't be Pepsi itself. If anything, it'll be the market. Meaning the overall environment just gets so ugly. Even the most beautiful looking setups, and I think Pepsi's top dog right now on my watch list as far as good looking setups. Just keep in mind here, it's liable to fall victim to the environment. Now, in terms of Pepsi on its own, this is super, super solid. Weekly, daily stack DMAs, weekly, daily green 10X bars. So from a weekly chart to a daily chart, there's trend, there's structure, there's momentum. Then you throw in the squeezes. Well, you got a daily, a 4-hour, a 2-hour, a 60-minute, 30-minute, and a 15-minute. So to your point, right, very much consolidation. But as of right now, it's consolidation in an uptrend with momentum to support another move higher. I think Pepsi looks really good here. And then Connor, let me see. Apple's another one where I don't think it's going to be an Apple problem. It's going to be a result of the indexes. In the short term, what I'm looking for here in Apple, keep in mind we got earnings next week. I think Apple could get down to 160, which is your weekly 21 EMA. Now, interestingly enough, in any other market, that's a buyable dip. Also, interestingly enough, Apple could fall another $5 here. You're still looking at a great weekly trend. So that's more just ebbs and flows of the market. We squeeze, we push, and we come on back home. We squeeze, we push, we come on back home. So I'm not saying I'm going to buy Apple immediately at the weekly 21, but in the short term, I do think you could have another $4 or so to the downside. If the market wasn't looking so sketchy here, I'd want to buy it. Lisa, always my pleasure. Always my pleasure. And then fares. Good question here. What do I do when I like a setup, but I see something that keeps me hesitant to take the trade? So in terms of hesitancy, right, that's typically coming from a place of, well, for me personally, I mean, in the past, hesitancy is coming from a place of fear, right? In my personal life, I hesitate to get on airplanes. I tend to just leave the airport and go home, to be honest, because I'm fearful of getting on the airplane. Right? So if I was, if there was a party on the airplane and I really wanted to be there, right, I'd run through that gate real quick. So a lot of times in life and in trading, hesitancy is a result of fear. So it's really helped for me, especially as of late. Going back to what we talked about earlier, before I pull the trigger, I'm going to identify my target to the upside. I'm going to identify my target to the downside. And then I'm going to structure different credit spreads, debit spreads, right? Working with different option strategies, trying to get a true sense of what's my risk reward look like here between those two levels. So when I'm shorting the small caps last week, I'm knowing damn well if I'm wrong and we rally back up to 222, I'm going to lose about $500. And if I'm right and we flush down to about 200, I'm going to make about 1,000. And now doing this removes a lot of, that element of mystery, right? It removes a lot of that fear. I'm going into the trade knowing my levels, knowing my game plan. We break through here, I'm taking profits. We rally back up here, I'm taking an exit. But more importantly, knowing what the risk and the reward is going to look like in both of those situations, there's not too much, mystery left. You might not be comfortable with the risk reward numbers. A lot of times that means, okay, if I don't like the numbers here, it just might not be a good trade. To your point, if the risk reward numbers don't make sense, I should probably be a little bit hesitant here. Or I should try to restructure the trade. But if we know where we're right, we know where we're wrong, we know how much we're going to lose, and we know how much we're going to make before we jump into that trade, it removes a lot of that emotion. Because for a lot of us as traders, it's like, okay, well, where do I take profits? Okay, this trade's working. Maybe I can make a little bit more. We're thinking too much. Then the trade comes against us and, okay, well, I'll give it till tomorrow and, maybe it'll break back down here. We don't want to think. Pick your levels, figure out the numbers, and if you're truly comfortable with them and you can truly accept that risk and it makes sense, I think you'll find that helpful in removing a lot of that hesitancy. At least that was really helpful for me. But listen, y'all, I got to be in the options room here in about 30 seconds. So I appreciate you spending some time with me this morning. Nice crowd here today. I hope y'all have a good weekend. As the market gets more interesting, so to say, make sure you you unwind on the weekend a little bit, spend time with family, and as always, I'll be hitting y'all with the weekly watch list video sometime Sunday morning. But with all that being said, have a great afternoon. For those of you in the options room, I'll see you in a few minutes here, and then I'll be in the training room later this afternoon as well. So, good way to start the morning, guys. Let's keep